Folks, let's talk about what's really happening in the oil patch this week. I'm Mark Roach with FutureWise Energy, and today I'm breaking down the latest OPEC Plus moves and what it means for American producers caught in the crossfires. The headlines are buzzing about OPEC Plus gradually unwinding their production cuts starting in June. After holding back to 2.2 million barrels per day since 2022, they're easing up, not all at once, but in measured steps quarter by quarter through 2025. This isn't just routine adjustment, it's a calculated strategic shift. Why now? Well, the cartels sees demand growth, particularly from China and India, and they're positioning to capture market share. But make no mistake, this is also about putting pressure on U.S. shale producers who've been eating their lunch for years. American producers are caught in a tough spot. WTI is far cry from those $90+ that we saw last year. The math gets complicated when you factor inflation-driven cost increases across the board from steel to skilled labor. The days of drill baby drill are behind us. Investors aren't bankrolling growth at all costs anymore. They want capital discipline, steady dividends, and sustainable operations. The result? U.S. production growth is tapering off despite decent prices. Let's look at the data. U.S. rig counts have dropped actually from 15% year over year despite relative strong oil prices. Production's still around 13.1 million barrels daily, but the growth curve is flattening. Meanwhile, OPEC Plus is sitting on about 5 million barrels of spare capacity they can bring online strategically. The Permian remains the crown jewel, but even then, the efficiency gains that drove the shale revolution are showing diminishing returns. New wells still deliver, but the eye-popping initial production rates that we saw a few years ago, 2018 to 19, are increasingly rare. The pressure is accelerating the consolidation trend. The majors and well-capitalized independents are gobbling up smaller players who can't weather these cross-currents. Just look at the $233 billion in M&A activity last year. That wasn't just about opportunity, it was about survival. Companies with diverse portfolios and strong balance sheets will navigate this environment. The pure play operators with high break-evens, well, they're either acquisition targets or headed for trouble. This is energy geopolitics in action. OPEC Plus is playing the long game, willing to accept slightly lower prices to regain market share and discipline U.S. producers. They're betting American companies won't flood the market with new supply given investor pressure for returns over growth. Meanwhile, global demand continues to steadily climb despite all the energy transition talk. The world still runs on hydrocarbons and someone's going to supply those barrels. The question is, who captures that value? For investors and industry players, this also means adapting to the new normal. The companies that will thrive are those with low break-even costs below $50, strong balance sheets with manageable debt, diversified asset portfolios, technological advantages in drilling and completion, smart capital allocation strategies. The era of easy money and growth at all costs is over. We're in a mature phase where efficiency, capital discipline, and strategic positioning matter more than raw production numbers. The OPEC Plus move isn't the death knell for U.S. shale, it's far from it. But it is another pressure point in an already challenging environment. The strong will adapt and will survive. The weak will be consolidated or collapse. That's the straight dope on where we stand. Keep your eyes on production numbers, not just prices, in the coming months. That's where the real story will unfold. I'm Mark Roach, FutureWise Energy, signing off.